agnostics, long-haired weirdos, short-haired weirdos, vandals, hooligans.
The government, hug the government, love the government, hug the government, love the government, hug the government.
Welcome to The Politics Guys, a place for bipartisan, rational, and civil debate on American politics and policy. I'm Michael Baranowski, a professor of political science at Northern Kentucky University. I'm joined today by my conservative counterpart, Cleveland area attorney and defender of freedom, Jay Carson.
Hey, good morning, Mike.
Hey, Jay, how are you doing this morning?
For those of you out there who have been wronged by Mike, I just want to say I am your justice and I am your retribution.
It is a long list, I am sure, and so it is good to know that you can turn to Jay or Donald Trump, or it's important to have justice and retribution. And I would probably turn to you before Donald Trump, but that's just me. Anyway, so we have a lot to talk about today. We're going to open with Silicon Valley Bank failure and just banking and bank bailouts, or maybe that's not the term in general. The potential TikTok ban, Biden's approving the Willow Oil project in Alaska, Ron DeSantis' remarks on Ukraine. So a whole bunch of stuff we have to get to, and we're going to get started in just 1 second. Okay, so Jay, in the last week, as I'm sure you know, listeners certainly know as well, there have been 3 bank failures in the United States, Silicon Valley Bank, Silvergate Bank, and Signature Bank. And the failure of a 4th bank, First Republic, was averted thanks to an injection of $30 billion from JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo. And of those 3 failed institutions, SVB is the largest with $209 billion in total assets, followed by Signature at 110.3 and Silvergate at just 11.3 billion. And while the FDIC insures depositors, that limit is $250,000, and that's far less than what many depositors had in those banks. In fact, 94% of the total deposits at SVB were uninsured. 90% at Signature were also over that $250,000 limit. And both of those numbers are considerably higher than the 47% average at the largest U.S. banks, according to S&P Global. Early on, the Biden administration announced that it would make all of the SVB and Signature depositors whole, but not bail out equity and bondholders. And President Biden on this commented, that's how capitalism works. Though, to me at least, it's sort of hard to square that with the decidedly interventionist move to repay depositors who knew they had significant uninsured funds in the banks, but more on that in a minute. The decision to repay depositors was based on the determination that not to do so could spread contagion to other mid-sized and smaller banks and thereby threaten the health of the larger financial system. And there's a provision in the law called the systemic risk exception that gave the administration the authority to take this action. Now, Republican Sheila Bair, who's the former chair of the FDIC, said that the move was puzzling. Her comment was, this is a $23 trillion banking system. It just doesn't make sense to me why banks this size, their failures would cause systemic ramifications. Now, Treasury Secretary Janet Yellen, testifying before Congress this week, faced questions from legislatures really of both parties about whether depositor bailouts were a new norm. And Yellen said that that wouldn't be the case, though I would say that skepticism is warranted given what we just saw. And the administration has emphasized that this depositor bailout, the cost of which won't really be fully known until the assets of the failed institutions are sold off, it won't be paid for by taxpayers, but it will be funded through a special assessment from banks as provided for in the law. And, Jay, there's a lot here, but in thinking about this issue, I keep coming back to a quote from Martin Luther King, who said, we all too often have socialism for the rich and rugged free enterprise capitalism for the poor. And boy, that sure seems to be the case to me in this instance. So what's your take on this?
I think that's a good analysis, I think.
So you and I and Dr. King agree.
Yeah, when Mike and Martin Luther King agree, who am I to jump in and disagree? Yes, I think that's the case. And I'm there are a whole lot of things that are reasons that I'm troubled by this. A great quote that I read, it was from this was in the Wall Street Journal, from a former Fed regional chairman, was that capitalism without failure is like religion without sin. It just doesn't work. And I think that there's something to that too, right? That, that's part of, if we don't, if there isn't a mechanism that enforces essentially market discipline, then you're going to get less and less discipline, and you're going to get more and more incorrigible children, as it were, right? That you continually have to bail out. So, that I think sums it up. Now, I think you and I may disagree on a lot of the reasons of how we got there. But I think there were a lot of reasons how SVB and these other banks got where they are. And the socialism, the reaction, I think we would agree on. I don't know, maybe we don't agree. That this sort of automatic, well, of course, we'll insure all of your deposits, even though there was never any deal to do that, and you were very sophisticated business people. And again, these were not mom and pop type operations that have more than $250,000 deposits. Now, I suppose you could say a lot of small businesses probably fit in that category. But when you point out that 94% of their deposits were above the $250,000 threshold, which again, that's the FDIC threshold was created to protect your mom and pop savers and your small businesses and those types of entities.
Yeah. In terms of how we got here, there's a way of looking at what, from what I read, is the question is, well, was it a bank run by idiots or a bank run by idiots? And I kind of like that. I think it's a little bit of both, actually, in that it's pretty clear that SVB, and in terms of its bond holdings, they knew that interest rates were going up. The Fed telegraphed that so much, and they put themselves in a bad position. And then the very concentrated tech sector folks, right? I mean, the bank was so very undiverse, decided to go ahead and take the run on, and that kind of becomes a self-fulfilling prophecy sort of thing. And so I think it's, like I said, a little bit of both. And certainly the executives of Silicon Valley Bank, they're going to be fine. Their CEO made something like around $10 million a year, and their senior team were all making $3 or $4 million a year. But they have
that'll rent you like a one bedroom apartment, of course.
Crimea River, right? But they have like 8,500 employees, and right now, from what I understand, they've been asked to stay on for 45 days at 1.5 times their salary. But then after that, well, so there clearly was a lot of poor management, right? And also some poor decisions by one of the first things you learn about investing is, right, to make sure you diversify, not put all your eggs in one basket. And so Roku deciding they're going to put around $500 million into this, hey, that's a pretty poor business decision. And like you said, there should be consequences. And clearly there haven't been, at least not, significant consequences.
So in some instances, though, I think sometimes those poor businesses decisions, are made also by poor business decisions by the bank in terms of a lot of the depositors. When you have the loan contract, you have as a provision in your contract that must be your exclusive bank, and you do all your banking there. The reason for that is so that if things do go south for the company, the bank can grab the cash first before anybody else. So I think there were a lot of those loans in place, but which on its face makes sense if you're a bank to do that. But the problem then is if you're only lending to that one type of customer, that in that one sector, and especially a sector that is especially sensitive to interest rate increases, you're putting yourself at risk. The other thing, and this is I'm not a Mike, you may be interested. I was the legislative aide to the Ohio House Banking Committee way back in the day, so I know a little bit about banking. But I don't know. I'm certainly not an expert, but I have worked in that field a little bit. And the issue that I've read about, which I think is fascinating, is when you measure risk, there's different types of risk, and these were the banks were investing in safe assets. They were government treasuries, and the sense is, well, look, that checks the box as a safe asset. But what they didn't look at was what's called the durational risk, which is, okay, how long you're holding them, and when can you liquidate them, and at what penalty. And that was the bigger problem. And I think from a regulatory standpoint, and this is, gets to me sort of under the way regulators were looking at this, there was one box to check, and it's like, are you invested in what are considered, quote unquote, safe assets? And the answer is absolutely, yeah, these are the safest assets you can get. But they didn't ask the second question, which was, okay, if you had to liquidate these assets, tomorrow, where would you be?
And I'm glad you brought that up, because this goes back really to the 2008-2009 financial crisis. And one of the things that came out of that was the Dodd-Frank legislation in 2010, which was largely a Democrat thing. There were no Republicans who voted for it in the House, and 3 Senate Republicans who voted for it. And those were kind of the usual suspects. Well, 2 of the usual suspects, Collins and Snow, and then Chuck Grassley. But the idea was that initially was that all banks who had assets of over $50 billion would be subjected to things like stress tests and have an unwinding, a clear plan for how they would unwind in this case, and capital requirements and things like that. But right from the beginning, a lot of these, it's weird to call, 50, 100, 150 billion smaller banks, but these smaller banks pushed back against this pretty hard and said, listen, we can't compete with the big banks if you're putting this regulatory burden on us. And so they lowered it in 2018 through something called the Economic Growth, Regulatory Relief, and Consumer Protection Act that lessened that oversight, dropped it down to $50 billion, up to $250 billion. Yeah. And at the time, there were a number of people who said, hey, this is a bad idea because these banks are going to be, that are under this $250 billion mark, they're going to be too big and too connected. They still pose some risk, and so we shouldn't be doing that. I mean, Elizabeth Warren said it, Nancy Pelosi said it, a bunch of folks said it, but that was essentially ignored, and they passed this, lessening of the severity, if you will, the regulatory relief from Dodd-Frank, and partly at the urging of, by the way, Barney Frank, who coincidentally ended up on the board of directors.
Dodd-Frank, yes.
Yeah, he was on the board of Signature Bank, and he was paid something like $2.5 million during his time on the board, and he was leading the charge for this, saying, I was wrong and it should be lower. And there's that's seems a little suspect, but my point here is that if you're going to bail these institutions out, then you need to have the regulation to make sure they don't take the crazy risks, because you can't have it both ways. In other words, you can't be lightly regulated and bailed out. That just doesn't work. And so we need to change that in some way. And I would expect you would agree with that.
And I know I agree to some extent. That's it. I don't know that, because I think you can agree to both. You could say that the drawing the line at 50 billion was too low. Perhaps 250 is too high. So I think you can, and I'm sensitive to the idea that regulatory costs are going to hit smaller banks harder, and there ought to be some safety net. No, not safety net, but realization that if you want a competitive banking system, you need to have a regulatory system that smaller institutions can work within, and that's not just a built in so that they're forced to merge, forced to be bought out, or close that way.
But there's a point, Jay, right? Before you get to the other point, there's a point I think you'd agree at which encouragement of competition becomes protectionism. And I think this is a real issue because, in almost every town in
I'd say
America,
it's almost the other way around.
well, I'd say in almost any town in America, there is, you have your local banks, right? And the bank owner, bank president, those folks are important people in the community. They have a lot of sway. And so there's a lot of support in Congress to help. It's just kind of like the same way with car dealerships, right? Which is why they tend to have a lot of influence in Congress, maybe more than you might think. But I think at some point you can, like I said, cross that line for you're not just encouraging competition, but you're protecting businesses that really shouldn't, in the nature of capitalism, should go in. Because it's not like we don't have competition among the largest banks in this country. We certainly do. And so I think it's reasonable to say, well, at what point are we going too far and not just encouraging competition, but protecting banks that shouldn't be protected? Yeah.
So I guess I'm not sure how we're let's put it this way. Ideally, you're not protecting those banks that shouldn't be protected because they ought to be held accountable and suffer the consequences of their own failure, right? And I would tend to see protectionism the other way, whereas it's the big boys write the regulations, knowing that the smaller institutions can't, keep up with that. Yeah. And that's that kind of crony capitalism type thing that says, listen, we're going to pass regulations that we can comply with, but it will it will raise the cost of entry into the market, or raise the cost of entry into the territory of where we are to compete against us. That type of competition. But that's the other piece of Dodd-Frank, and this I think goes to, and this isn't even political. It's a matter of people and companies respond to the metrics by which they're measured, right? And in this case, Dodd-Frank and the rules that went with it created this sort of risk weighted capital idea that you're evaluated by regulators on this, how risky are the assets. But it's only checking that one box. And, well, no, there's again, more than it. That's part of it. But right. That's a huge oversimplification. Well, this is this is a Saturday morning show, and I'm trying to break something down into something simpler. But my point is that the idea is, look, the banks knew that if they are we're holding all treasury bills, they're going to get a clean regulatory bill of health. Even though common sense would dictate you're still exposing yourself to that durational risk if interest rates go up. Now, maybe there also might have been the idea that they thought, well, look, we're living in a modern monetary world and interest rates will never go up. So we're golden. There could have been that presumption. Or there also could have been the presumption, which bore fruit, was like, hey, look, if something happens, surely the government's going to bail us out. Now, I don't think bankers think like that just because of nobody wants the bank to fail and then have to go to the government for a handout. But there is still that sort of that sense out there, I think, in some cases of, well, look, if worst comes to worst, they're not going to just let our depositors hang in the wind. So, and well, they certainly there's no provision in the law that the systemic risk exception. There's nothing that says that FDIC had to make all of the depositors whole. I mean, not at all. Yeah. And they could have, for instance, said, you know what, we're going to make you 90% whole. But they chose not to do that, which is to me what really stinks to high heaven, because I think they could have done enough to avoid the contagion without actually saying, well, we're going to give you everything back. To me, that's just that's crony capitalism. It seemed to me there wasn't even any thoughts given before that answer came out. Yeah, just we'll do 100%. I sort of barely remember, but then I remember from the history during the 80s S&L crisis. Which actually hit Ohio fairly hard. There were several Ohio S&Ls, and this is sort of the history I learned when I was on the Ohio House Banking Committee as a staff member. But yeah, I mean, what this resulted in was months and months of negotiations of the state taking control of certain institutions, and then working out this long-term deal about how this is going to work and how much of a haircut everyone was going to take. It wasn't just this, because again, like S&L deposits in a state S&L were not federally insured by the FDIC. It's instead of just taking this step back and working through a big piece of legislation with multiple political compromises, this just seemed an off-the-cuff, reflexive, don't worry, we got you covered. And I think that's bad long-term for the industry, because it sends the signal.
Now,
not only are we still in the area of like too big to fail, we're just like nobody's going to fail.
Yeah.
So,
well, in the defense of FDIC and Treasury, they needed to do something quickly, but again, that didn't mean they just had to say 100%. They just could have said, well, we'll make sure.
No, they still could have said we're seizing control. We're freezing the funds. We're going to start allowing this much to come out and so forth.
Right. Enough so you can meet payrolls and that sort of thing,
Yeah.
but we're not going to just guarantee you everything. Yeah. And they didn't do that.
Yeah.
And, in terms of how this is going to play out, I mean, the FDIC is funded through charges to banks. It's right around 12 cents for every $100 in insured money. And the deposit insurance fund is currently somewhere over $100 billion. And so, okay, the Treasury Secretary, Janet Yellen, she's right. It's not going to be funded by taxpayers. But what's going to happen, though, is that special assessment. I mean, that's going to go, basically where
ATM fee.
Well,
yes.
Yeah, so, I mean, responsible institutions are footing the bill for these irresponsible institutions who are going to end up passing that along, like you said, to customers. So we really are footing the bill for this, which is why it's, again, socialism for the rich here.
Yeah. I'm against socialism across the board.
Yeah, rich, poor, it doesn't matter. And I will say also, though, we do need to consider the costs versus the benefits of regulation, because I think it's right to an extent that smaller or lower restrictions on these non-mega banks help them in that innovation economy, and that can be tough to measure exactly how much, and it's also tough to measure how much the eventual bailout's going to cost after these assets have been sold out and so forth. But I think clearly we didn't get the balance right here, because the whole point of Dodd-Frank was to avoid a situation just like this, where all of a sudden everyone's panicking, saying, well, we need to do something. Well, let's just throw money at the problem. And I know you're not in favor of throwing money at hardly any problem.
No, I'm same feelings as socialism.
Yeah. Now, go ahead.
But I would say sometimes I go back to the quote I mentioned earlier, that capitalism without failure is like religion without sin. There has to be an acceptance that regardless of whatever your regulatory system is, things will happen, and it's like again, I have all the pithy quotes and old adages here, but it's sort of generals are always fighting the last war. The same thing goes with regulators, right? They're always fighting the last whatever economic issue was. And the last time it was liquidity. It wasn't what we're dealing with here. But not that this isn't liquidity, but it's liquidity in a different sense. Before it was like the banks just couldn't get money, right? There was no money in the pipeline. But in this case, these are actual losses, and it's just it's more. Let me put it this way: it's more of a cash flow problem. Making sense.
I guess sort of.
You know what I'm saying? It's the inability to respond quickly to those withdrawals.
Well, and
that they didn't anticipate.
But that's the problem, and that's the depositor part of it, where I said maybe it was a bank run by idiots, because in that sense that, well, when you have this very small, tight sector and you have whatever influencer leading voice is saying, oh my God, get your money out of SVB right now. And everyone just kind of rushes to the exit. If you get enough of that, no bank's going to be able to handle that, no matter what they have in reserve. Yeah. And so in a way, you have to blame the tech community for being knuckleheads and rushing to the exits.
Well, it's sort of what I'm saying is that there's no regulation.
Yeah. Okay.
That can prevent every bad event.
Yes, absolutely.
And sometimes what happens is you will have new bad events based on whatever the new regulations are. Right. So. Which is
not to say that we don't need to have regulations.
I'm not saying that.
Just saying that regulations are imperfect by almost
exactly.
Yeah.
Absolutely. By nature. Then that's the whole point. And maybe the better route is less regulation and more risk, with people being properly cautioned and understanding that risk.
Except right.
More risk, more reward.
But that's not how it works, because if you're big enough, or if you're connected enough, you can take all the risks you want if you're not regulated, and you know that in the end, the government has your back. And Janet Yellen and the Treasury just proved that, just like it was demonstrated in 2008, 2009. And that's, like I said, that's the problem with
I would even make a distinction between 2008, 2009 and this, in that 2008, 2009 with TARP were loans. That were put in to shore up the bank's lending ability, and those loans were in large part paid back
with interest.
This case is it's actual losses, depositor losses that are just being covered, which is a bigger problem. Now, I suppose that there might be some later solution where the government says, well, you're going to fund back some of this SVP or again, at this point, it looks like it's just other banks that were the more responsible actors covering the actions of the less.
Because we had this conversation, at least not, you and I didn't, but it was had plenty of times saying like, well,
the nation had this conversation.
Yeah, exactly. Right? What's the guarantee that we just won't bail them out again? And say, well, no, we won't. Just like Janet Yellen said, oh no, this isn't going to be something we're going to do. Well, of course it is. I mean, that's just how it works. There
were still a few lonely voices in the wilderness crying out that no, we shouldn't bail them out in the first place.
Yes. And, there's also this idea from some folks, at least on the right, that wokeness was somehow a cause. And I'll say that there's really no basis in fact for this, because SVB was no more woke than most other banks. Somewhere around 8% of its assets were in ESG, whereas if you take a look at the three largest U.S. banks, JP Morgan, Chase, Bank of America, Citigroup, they're all between like 8 and 14%. So if anything, SVB was on the lower end of this. So I think that was just a way to say, hey, look at these California woke folks who are focusing so much on, diversity and so forth, and took their eye off the ball. That to me is just kind of a way to try to score cheap political points with people who don't really understand how all of this works.
Well, yes and no. So I would, because I was thinking about that, and I would tend to agree the bigger issue is not, it wasn't wokeness. It wasn't that was the major contributor. But I think, in fairness, you can, and I'm of two minds of this. My first thought was, well, but it sure didn't help.
How do you know that?
If you look at,
wait a second. Well, let me back off. When you say,
wait a second, I'm going to get back to. Let me
okay. Sorry, go ahead.
Because you'll like the finish.
Oh, okay.
So I thought, no, it probably didn't help. In that, from what I understand, SVB was investing in a lot of companies that were sort of these political darlings, right? Hey, we're about sustainability, environmentalism. What do you guys make? Well, nothing really. And how much is your what are your profits? Well, we don't really have any. It's all speculative, and it's all sort of. There's a little bit of a presumption of look, there's a flood of government money coming. We're going to cash in on that, right? I think you can argue that in that case, they maybe made some riskier loans than they ought to have, based on that sort of social capital.
Oh, absolutely. But that's different from the wokeness thing. That's just a question about, like you said, that was part of their whole pitch, is that we will help out these startups who don't have sort of the traditional they
don't actually make products.
Yeah, at this point, because that's how the tech sector works to a greater extent. But that's different than
you're investing in some future return at some far
exactly.
Off date. Yeah,
but that's different than the wokeness
which is all the more. That's why interest rates matter, because there's no actual cash coming in. Yeah,
absolutely.
So to that extent, I think there is something to it. That these companies were sort of, and it's almost like back in the late 90s, early 2000s, right? The idea was, you could walk into any investment house in Silicon Valley, and you say like, "Hey, look, I'm starting a website too," and they're like, "Let me stop you there. Here's the money."
Yeah.
Mm-hmm. You know what I mean? It was sort of no questions asked, they were just throwing money out there because, hey, anything that had internet attached to it was going to be gold.
I agree.
And then there was the .com bubble burst, and I think you have sort of this ESG bubble, if you will, that's out there.
But see, that's a different thing. I think you're conflating two things. That
you're saying ESG is different from wokeness in terms of. Did the bank spend too much on
not only that,
DEI officers or something? Right?
Not only that, but I'm saying that the reason they failed wasn't because of these, even somewhat questionable investments. It was because there was a bank run, and that's a separate sort of thing. So that's why I see what you're saying, but I think it's just such a minor thing.
If these wokesters had had a little bit more social consciousness and just left their money where it was, and hadn't been greedy capitalists and tried to take it out right away, we would have been better off.
Well, if they'd just been smart, that's all. Not greedy. It just would have been smart to not.
Well, no, but in a bank run, there's no.
Yeah, but that's true.
Smart,
right? That's right. Yeah, because it starts. Yeah, you
are depending on the smartness of everyone else.
Yes, absolutely. That's always a losing bet. Sure.
Yeah, nothing to fear but fear itself. Yeah. Right.
Go ahead.
But let me finish, because here's the kicker. This is the part that I think you'll like.
Okay.
In the end, was it perhaps wokeness that saved SVP?
What do you mean?
Well, this is someone posed a hypothetical question. If this had been the first oil and gas bank of Houston, would the government have rushed in to protect those investors the way they're rushing in to protect depositors?
Absolutely, no question in my mind. I mean, there's no way we could know, and certainly folks on the right want to make that argument, because it's all about the money. It has nothing to do with the wokeness thing.
Well, it's banking, Mike. Yes.
Yeah, that's what I'm saying. Exactly, it's banking, and because these institutions were too interconnected to fail, this wasn't done. The bailout, or whatever you want to call it, wasn't done because of wokeness. It was done because there was a concern about the spread of contagion to the larger banking industry, and so that would have been the case whether they were energy focused banks or tech focused banks or anything. So yeah, I think that's a easy question to answer. So yes,
again, it's a hypothetical,
exactly,
and so we won't know. But I think we'd have to agree to disagree on that. I think if it was a different kind of bank, a different kind of depositor, I think the reaction might have been, well, it's, you pay your money, you take your chances.
So let me get this straight. You're saying that if it had been, say, the first Texas bank of oil and, destroying the environment,
a bank that was heavy, and
You're saying that if Treasury had decided that there was significant risk of contagion to the broader banking industry, they would have said, well, that's just too bad. We don't like oil companies. We're going to let the banking industry just sort of flop around. And is that your argument?
No, my argument is, although that's maybe a variation of it. My argument is that Treasury's view of a contagion might be colored by the people who are getting sick.
Gotcha. Okay, yeah, we are going to have to agree to disagree on that one, because I think you're entirely wrong about that.
My sense might be that the Treasury, and to put that in other words, that the Treasury Department might look at this and say, well, it's this small sector, they're really kind of insulated. They're not going to have that over. But when it is a
Gotcha.
this is what you said a minute ago. It's socialism for the rich.
Yeah, you're basically questioning the integrity of Treasury more than I am.
Yes.
Okay. All right. Fair enough. There's one other aspect of this I wanted to bring up, and actually, it's thanks to one of our listeners and supporters, Jordan, who wrote on Discord. He said, "How is it that bank failures?" And I think Jordan's Canadian, I believe. He said bank failures in Canada from 2000 to 2023, 0. United States, 562, according to the FDIC. And I was curious about that, so I looked into it. And it turns out that there are 6 banks in Canada that account for around 90% of market share. And that's way different from the U.S., where our top 6 account for around 55% of market share. And so, I mean, you have the situation where the Canadian banking industry is much more consolidated and therefore much more, I think, more, you have these fewer banks that are more highly regulated. And, this is part of the problem, I would argue, is that right now we have 11 U.S. banks, just 11, that are over that $250 billion limit that are subject to the full Dodd-Frank regulations. They have roughly 68% of market share. Now, had we kept that $50 billion limit, there would have been 42 banks with 96.6% of market share under those rules. And okay, you can say maybe that's a little bit too much. So let's say we even lowered it to 100 billion instead of 50. Well, that would have been 34 banks controlling around 93% of the market. And so I think, and you alluded to this earlier, I think you can make a case for, say, well, okay, 50 billion was too low, but maybe 100 billion is more reasonable. And perhaps that, along with raising the cap on FDIC insurance, I mean, that was done after the financial crisis. It went up from 100,000 to 250,000. So maybe we say, bring that up to, from 250 down to $100 billion, and also raise the FDIC limit to say, I don't know, 500,000 or something like that. What do you think about that?
Look, I could probably go back and forth with you on the numbers on the, where the cutoff is.
Yeah.
I would be less agreeable to raising FDIC stuff. That would seem to be that. I suppose at least we're being a little more honest there, right? But I think that would encourage that more institutional risk,
or maybe indexing it at least in some way.
Yeah.
I mean, what do you think about that? Because I mean, it's if we never raise it, I mean, certainly $250,000 in 20 years is going to be. Well,
let's put it this way: you have to raise it at some point, right? Just with inflation and so forth. So I'm not opposed to periodic increases, but I am opposed to the periodic increase in that. We'll just insure more deposits. That way they'll be insured, and we won't have to do this special political thing. You know what I mean? That troubles me, because I think that lowers takes more of the actual risk out of the market, and encourages riskier behavior. If you follow me.
Yeah, absolutely. I mean that whole
it's almost hazard. Like it's the. Hell, I'm insured. I'm going to go ahead. You know what I mean?
Oh, absolutely. That whole, like I said, the whole issue of moral hazard is just huge, and you take that out, and then you're just going to get this. Yeah,
moral hazard.
Exactly. So,
so no, I'm not crazy about doing that. Just willy nilly, just to say, hey, these are more safeguarded. What I think the way to do it, it's almost the opposite. Is have fewer insured, lower insured accounts, but higher risk, higher reward.
Sure.
For people who want to do that.
But the risk actually has to be there. That's the thing.
Exactly. Yeah. Exactly. Yeah.
Because ideally, you want lower risk, no risk, and higher reward, but that doesn't work in the long run.
Yeah. Now it's high risk, but you don't really accept that risk. The government, you have the idea that the government's going to cover it eventually. Oh gosh, there was something else I was going to throw in there. Oh no, just to say, banking, and this is in American history, banking is really almost, in terms of its constitutional political arguments, it's almost a a bigger source of controversy than slavery through the early republic, right?
Sure, the Bank of the United States,
big
second bank,
fights,
all that.
yeah.
Yep. Absolutely.
The questions that really blew up and separated the nation revolved around banking, which sounds weird to us today. But it was the case. And it's almost kind of ironic. The arguments that were made in favor of rejecting national banking laws were later said, like, hey, you know what, we could apply this to slavery as well. For example, the nullification doctrine.
Yep.
So and implicit in that was there was a unique, maybe not unique, but particular American fear of having these large banking powers, that they would be in a lot of ways undemocratic. And that's the more democratic, small d democratic, and at one time capital D democratic, way to handle this was to have many small banks, as opposed to have your big leviathans that controlled a lot of capital and controlled a lot of political power with that. And it goes back to things like, the ideological feud between Thomas Jefferson and Alexander Hamilton. And so to me, I think if you're comparing, I'm just bringing all this up because if you say, why is Canada so consolidated while we are less?
Oh, yeah.
I think there's a lot of historical reasons for that. Another part of it is we have a federal type banking system, right? Where you have federally chartered banks. You can also have state chartered banks. And that's adds a little different complexion to it. I don't know how it works in Canada, but you have more smaller state chartered institutions than I'm betting you do in Canada.
Yeah, I'm sure that's right.
And I would be one who argues on the side of I think that's a good thing.
You mean having more smaller banks?
Yes.
Well,
the small d democratic argument. Well, the Jeffersonian argument.
Yeah, again, that goes back to what we talked about, or what I was getting at a little bit before. I think to a certain extent, yeah, it's good to have that competition, and there's reason to fear having one bank that has huge market share because of the power. And you can even argue that, well, J.P. Morgan Chase, something like $3.2 trillion.
Yeah, you could argue. I would agree. Those, big things are too powerful as is.
But then again, that whole argument for breaking up the big banks that went nowhere. But in part because they are so powerful, I think.
Yeah.
So, all right. Well, let's move on to our next story here. Unless you have anything else to add on that, Jay.
No, that's yeah.
All right. Well, let's go ahead and do that. So, moving on. Not all that long ago, you and I talked about the possibility of a TikTok ban in the U.S. And since that time, the pressure has been really mounting for what Donald Trump called for as president, that TikTok either sell to a U.S. company or face a complete ban in the U.S. And this week, the Biden administration told the company that if it doesn't sell its stake in the U.S. version of the app, that it will face a total ban in the U.S. And, as we discussed the last time this issue came up, the federal government has already banned the use of TikTok on government devices, and a number of U.S. states, I believe 31 at this point, have taken similar action. And I should point out that the U.S. hasn't been alone in this. I mean, India back in 2020 banned TikTok along with a bunch of other Chinese apps. And more recently, there have been bans on TikTok on government devices in countries including the UK, Canada, New Zealand, Belgium, the executive branch agencies of the EU. So there's a lot of this going on. And in this country, earlier this month, the House Foreign Affairs Committee advanced legislation called the Deterring America's Technological Adversaries Act, or the DATA Act. They always love those acronyms. And that would give the president the authority to ban TikTok, which, by the way, at this point has somewhere over 100 million users in the United States.
Notwithstanding the First Amendment. But that's something else.
Yeah. Well, now ByteDance, which is TikTok's parent company, of course, their executives say that they already store all their U.S. data in U.S.-based servers controlled by the U.S. tech company Oracle. It's part of their Project Texas plan that they've reportedly spent over $1 billion to implement. And so that already secures the data of U.S. users from access, by China's government. And TikTok spokesperson Maureen Shanahan said, if protecting national security is the objective, divestment doesn't solve the problem. A change in ownership would not impose any new restrictions on data flows or access. And the best way to address concerns about national security is with transparent U.S.-based protection of U.S. user data and systems with robust third-party monitoring, vetting, and verification, which we are already implementing. And finally, Xiao Zhiqiu, who's TikTok CEO, is scheduled to testify in Congress next week, and I am sure he will get a grilling from both Republicans and Democrats on the House Energy and Commerce Committee about all of this. So, Jay, I guess, do you expect that we'll see a sale or a ban of TikTok at some point in the near future? And larger than this, is all of this, in your view, a reasonable reaction to a significant security concern, which, the FBI and other agencies have suggested we have here, or is it just kind of an anti-China overreaction?
So I think there's a security concern. I don't know that I have the information to say whether how big, how broad it is. When we talked about this last time, I think it's certainly appropriate for the government to say we're not going to allow TikTok on government devices or devices that could tap into government networks. That seems to be pretty smart. I think the same thing goes for a lot of smaller local governments making those same decisions. I'm less crazy about a total ban on a service announced by the president, just because I don't know that that's constitutional.
Explain why do you think that is?
Well, because I think it's if you say, listen, part of I have a right to speak freely and express myself. I'm choosing to do it on this platform. And the government says I can't. I think that's, I have a right to get information.
I don't see a First Amendment issue here, really. I mean, because it's not banning the speech; it's banning a specific platform, which poses, in the view of a number of U.S. government agencies, a significant security risk. And so,
well, in that case, I think we could just go and we'll ban the New York Times. They seem to be more of a problem than others to me. So you see what I'm saying?
Well, yes and no, because you'd have to say
in some cases the platform is the medium is the message.
Well, I mean, yes and no. Certainly, any sort of because this isn't banning. Again, this isn't banning speech. This is banning a platform, and so even if maybe you would say, well, this would have to fall under strict scrutiny. But I think if you can make there have been plenty of instances,
and maybe you could make a strict scrutiny case, right? Yeah. I wouldn't disagree with you there.
Okay.
That maybe if you can show that the national security interests are significant enough that a nationwide ban on civilian use passes strict scrutiny, I could see that happening. And here's the thing, Mike. I'm not as a policy perspective. I'm not against people getting rid of TikTok altogether. I don't have TikTok. My kids don't. Partly because I mean, look, it's for me to say I don't have TikTok because I don't want the Chinese government spying on me. That's not entirely true. It's more just like I think it's stupid, and I'm not interested in it. But So, but what I'm saying is I don't disagree with the risks and the policy behind a TikTok ban. I just question whether that would be constitutional.
Sure, certainly there would be a lawsuit.
And also, I question the other thing I question after that is, how I like my slippery slopes.
Oh yeah, big fan.
Could the next thing be? Well, listen, we're really concerned about domestic terrorism and right-wing activism, and they're going to storm the Capitol again.
No, I get it.
So therefore, let's ban X.
That the slippery slope is your favorite logical fallacy.
It
for
is.
Sure. No
it
question. Is. But, I would also say that there are two issues here. It's not just the data that the Chinese government could potentially get in secret, but it's also the idea that the app could be used, the algorithm could be used to push misinformation out to users as well. And so the security.
But understand that sort of falls right into where I was with the First Amendment thing. That, look, I mean, I am one to say pretty much everything. If the Chinese government says today's Tuesday or today's Saturday, which it is, my inclination is going to be to disbelieve that instinctively. Right?
Except people won't know it's coming from
the
I hear what you're saying, but I think, users of TikTok, and I have plenty of students who are users of TikTok, they don't think of it as a Chinese app that the Chinese government could be passing messages. They just think of it as a fun way to get whatever, short videos on all kinds of things. So that's what I think makes it dangerous, is that most people aren't going to make that connection, that association, just like most people, when they saw misinformation about the COVID or the 2020 presidential election, weren't saying, oh, this must be Russian bots. No, they were just saying, oh, I saw this on Facebook, it must be true.
Well, again, that goes back to my point of, as much as I dislike misinformation, I don't think you can constitutionally just go around banning certain speech because the government labels it misinformation. Much of what was misinformation one day turns out to be actual truth later on. So
sure.
that's my First Amendment concern.
But again, the government isn't banning speech here; it's banning a platform. It would be banning a platform.
But you just said, part of the reason for banning it is to prevent speech, to prevent misinformation.
Right.
Misinformation could also be described as speech the government doesn't like.
Absolutely.
Or doesn't like that day.
Right. But that's only part of it. The other part of it is to prevent a hostile foreign power from gaining access to sensitive data about millions of Americans. So, okay. What
I'm saying is if the First Amendment covers one part of it, it covers all of it. Maybe you get, and again, you go to a rational debate or a
strict
scrutiny, and maybe you say the danger of the data breach by the Chinese and Chinese spying outweighs, in this case, the free speech. It is sort of equivalent to national intelligence and clear and present danger, or fighting words, those types of exceptions.
And I'll agree with you. It's a harder case to make than in some instances, because we're talking about potential abuses and not demonstrated abuses, and that gets tricky, right? And so it's not a slam dunk case.
It would be a tough case to prove at court.
Yeah.
To say here's the what's happened and what will happen, because we got these systems in place that protect all the data and so forth. And my sense is, you do until you don't, right? Or until you just change your mind and say, yeah, we will give it all to the Chinese.
Yeah, exactly.
Yeah.
And I think we need to consider this as well in the broader political context, right? With the whole balloon incidents and what recently reported this week that China has been sort of covertly assisting Russia, sending something like 1,000 rifles and body armor and drone parts. They're doing this through cutouts in Turkey and the UAE. And so it's this,
that doesn't sound like that, Mike.
Yeah. But I'm saying all of this is connected.
I argued months ago that, of course, the Chinese are helping the Russians and are going to help the Russians, and
maybe not in a big way, but certainly in a way that raises. They would probably be doing more if we weren't watching so carefully, certainly. And so what I'm saying is that part of this pressure, we have to consider this as maybe we're putting pressure on them in this way to get concessions in other areas. We should never look at these in international relations. You never want to look at an issue as just the issue, because it's almost invariably interconnected with a whole bunch of other issues. And certainly that's the case with China.
Yeah, no, and I agree. And to be clear, because the stuff I say is always sort of misconstrued, but you're not going to find a bigger adversary China. I shouldn't say that. That's an insult to the good people of Taiwan. But yeah, I mean, I am certainly.
You're not a fan of China.
More skeptical. Yeah. I'm not a fan of China in any way, shape, and I should say I'm not a fan of the Chinese government.
Right.
In any
exactly.
way, shape, or form. Again,
yeah.
nothing but sympathy for the Chinese people.
No kidding.
But and I'm not a fan of TikTok. One, because it's run by the Chinese government, and two, because I think it's just kind of dumb. But three, that doesn't allay my concerns about is this constitutional or good policy. I think the better, so.
And just to be clear, TikTok's not run by the Chinese government, but because they are a Chinese company and how the law works, China has the ability to access or demand access to information that wouldn't be the case for U.S. companies.
Correct. No, I mean, I'll put it out more bluntly. Every Chinese company is indirectly at some point run by the Chinese government.
Yeah, absolutely. I would agree with you on that.
In a way that companies in the West are not.
Yes, no question. So do you think we're going to end up seeing a sale or a ban? What's your prediction on that?
I think there might be some sort of a sale. And again, I would agree. I don't think that solves the problem. That maybe adds an extra layer of insulation. And I suppose if you do have this a robust third party review, that helps. But I'm not sure how you guarantee that.
Well, yeah,
right. I'm sort of a who watches the Watchmen type situation. So I'm yeah, that's right. I think the better way to go is to just get the word out. Hey kids, TikTok ain't cool.
Yeah, that's good. That's going to work.
Just say no to this is your brain on TikTok. Just say no to TikTok, or much better, come up with a real American alternative.
Well, I mean, Facebook and Twitter and everyone else has been desperately trying to do that, but they just haven't been able to replicate it. Essentially, so that's the problem. And looking at it from the Chinese perspective, I could sort of see how they might see this as part of a kind of massive anti-China overreaction, saying, "Hey, we have this service and we haven't used it for anything nefarious in any way, and you just want to take it away because you can't compete with it." And that's that in the context of also putting legislation in place to try to hobble the Chinese tech industry, right? Or at least advanced, semiconductors and that sort of thing. And so from China's perspective, I could totally understand how they feel this is unwarranted, although obviously we feel somewhat differently about it.
Well, they also may feel that this interferes with their plans for global domination.
Yeah, see, I don't really think they have plans for global domination, but
I think that's part of it as well.
But do you really think they have plans for global domination?
Yes.
Really?
Absolutely. Don't you?
No, not at all. I mean, I think they certainly want to be an economic power, and they are.
Maybe global domination is too strong and said, partially tongue in cheek. Global hegemony.
I don't even think they want hegemony. Hegemony is it's just too much work. There's too much involved. You have too many responsibilities if you're a hegemon. But if you're just
they got the people. They got a lot of people. They got
their own problems. So no, I don't think anyone really wants this job anymore. Certainly, and so they're kind of glad that the U.S. is stuck with it. So yeah, I that's not to say, certainly, like you, I am no fan of the Chinese government, but I do not think they have any real interest in American-style global hegemony, or at least not as much as you might think.
Yeah, well, I think we can differ on that, and we'll see. And I would also, I just want to throw out, as far as my slippery slopes go, if I had said 6 months ago when we talked about this before, I said, Mike, you know what? The Chinese, I bet the Chinese are secretly giving weapons and ammo to the Russians and intervening in Ukraine for the Russians. that would have been labeled by everybody, including our government, as outright misinformation.
I don't think so.
And if we're allowed to ban misinformation, that would have been subject to being
I disagree. I disagree. I think it would depend on how you would have said it. If you would have said, the Chinese are, I know for a fact that the Chinese are doing this, well, that would be misinformation. But if you simply said, I think that it's likely that the Chinese are doing this, well, that's a whole different sort of thing. So a lot depends on how you present certain things. I mean, there's lying and then there's speculating, and they're very different things. And so no, I would disagree with that. All right. Okay, well, on that disagreement, we are out of time. But before we go, why don't we end with some recommendations? You got a recommendation for me this week, Jay?
Can you go first?
I sure can. I recently watched a movie that was a lot of fun in a weird way. It's called Triangle of Sadness. It's basically about a bunch of very rich people on a yacht, and bad things happen. And it's sort of a fun, in a way, critique of capitalism. Woody Harrelson has a role. It's a lot of fun. It's an interesting movie. I enjoyed it. And of course, I'm always up for a critique of capitalism and poking the super rich as much as possible. So I would recommend Triangle of Sadness. That's mine for today.
Oh, okay. Gosh. So I'm just going to go, I will say Shostakovich's Fifth Symphony. Go listen to it. That's my recommendation.
Okay.
And again, this was that is sort of a poking at communism, as it were, and Stalinism. And one day we can talk about that at length. Actually, the Cleveland Orchestra is going to be performing that in a couple weeks. I'm going to be going, but yeah. So that's my highbrow recommendation, and it's more like because I couldn't come up with something quickly on the fly, but that's always a good standby. Go and listen to Shostakovich's Fifth Symphony, right. and also read about it. Listen to it first and then read about it, because if you read about it first, it might give away the spoiler alert. So listen to it, read about it, and then listen to it again. And then report back to Jay. It's like a homework assignment you're giving people. Yeah. Anyway. All right. Well, before we do go, I just want to also thank Pierre and Mickey, new supporters who actually, both of them took advantage of our fairly new Patreon free trial feature. I set it to the longest trial period Patreon allows, which is 1 month. And after that point, you can either cancel and go back to being a non-supporting listener, or decide to become a continuing supporter, or if you don't know by then. Yeah, exactly. And so, or you can just send me an email, mike@politicsguys.com, if you're not in a position to financially support the show, but you want to keep on getting the full midweek show. Hey, that's great. And in fact, in just a minute, Jay and I are going to be recording the midweek show. We're going to be talking about the Biden administration approving the Willow Oil Project in Alaska, Ron DeSantis' remarks on Ukraine, and continue our series on American greatness. So we have a bunch of cool stuff, I think, coming up, and we hope if you're a supporter, you enjoy that. So, and then finally, also, thank you so much to our executive producers, a wonderful group of people: Bruce Johnson, Wilma Moreno, Andra Masker, Daniel Toe, Ryan Beasley, and Don Oglesby. And we'll be back with a new episode for you next week. We hope you join us.